Hi everybody, and welcome back to video number 2 in chapter 18. And when we left off, we were finishing the Chelsea example in 2027. And if you remember, the difference in 2027 between the book basis and the tax basis of accounts receivable is 0. So here is that 30,000 less 20,000 less 10,000. So income taxes payable for 2027 is going to be $16,000, and that's $80,000 times 20%. Now, what is Chelsea's income tax expense in 2027? And what is the journal entry to record income tax expense, income taxes payable, and the change in deferred tax liability in 2027? Okay, for income tax expense in 2027, we'll start with our income taxes payable, the current tax expense for 2027, which was $16,000. Now, the deferred tax liability at the end of 2027 is 0, and deferred tax liability at the beginning is $2,000. So that's going to be a bit of a benefit of $2,000 here. And so we will add that minus $2,000 to $16,000 to get income tax expense for $14,000 in 2027. So, as indicated, the determination of income tax expense starts with income taxes payable and then subtracts the decrease in the deferred tax liability of $2,000 during the year. So as we record the journal entry, we'll record the income tax expense, the change in the deferred tax liability, and the income taxes payable. So income tax expense is going to be our standard $14,000, but the deferred tax liability is going to be an additional $2,000. So our income taxes payable will be $16,000. So I think if you followed those slides through, you follow pretty much how we would do this. All right. So if we look at the T account for deferred tax liability, initially we had this $6,000 deferred tax liability credit, and then it was offset by 2026 and 2027. And the deferred tax liability at the end of 2027 would have been zeroed out. So, balance sheet presentation for these deferred liabilities. Here's our year ends, and here's our income taxes payable, and here's our deferred tax liabilities. And then the income tax expense will be $70,000 less $14,000, which will give us a net income of $56,000 in all 3 years. Okay, so if we look at a partial income statement, here's our income before income taxes. Here's our income taxes expense, $8,000, our deferred income tax, and that's a total of $14,000 income tax expense, and our net income of $56,000 per GAAP. Now, let's take a look at temporary differences, this time with a warranty liability. And to illustrate a temporary difference resulting in a deferred tax asset, we're going to assume that during 2025, Cunningham Incorporated estimated its warranty costs related to the sale of Microsoft microwave ovens to be $500,000, paid evenly over the next 2 years. For book purposes, in 2025, Cunningham reported warranty expense and a related estimated liability for warranties of $500,000 in its financial statements. So for tax purposes, the warranty tax deduction is not allowed until it is actually paid. So therefore, Cunningham recognizes no warranty liability on a tax basis balance sheet. Okay, so per the books, we have estimated liability for warranties of $250,000, $500,000. But for tax purposes, the estimated liability for warranties is 0. Okay, so we can think about this situation another way. One, these future deductible amounts cause taxable income to be less than pre-tax financial income in the future as a result of an existing temporary difference. And then 2, Cunningham's temporary difference originates or arises in one period, that's 2025, and reverses over 2 periods, 2026 and 2027. So here, our cumulative temporary difference is $500,000, and then it offsets in 2026 and 2027. So our taxable income is lower than pre-tax financial income in the future, but higher in the current period, 2025. Okay, a deferred tax asset represents the increase in taxes refundable or saved in future years as a result of deductible temporary differences existing at the end of the current year. So we're going to assume the Hunt Company has revenues of $900,000 for both 2025 and 2026. It also has operating expenses of $400,000 for each of these years. In addition, Hunt accrues a loss and related liability of $50,000 for financial reporting purposes because of pending litigation. Hunt cannot deduct this amount for tax purposes until it pays the liability expected to be in 2026. As a result, a deductible amount will occur in 2026 when Hunt settles the liability, causing taxable income to be lower than pre-tax financial income. So the following illustration shows GAAP and tax reporting over the 2 years. And here we have our GAAP reporting, and here's our $900,000 in revenue, and our income tax expense of $90,000 and $100,000. The litigation loss of $50,000 is shown here in 2025. But for tax purposes, we're not going to see that as a reduction of income tax until 2026. Okay, I think that's clear. So if we continue with the Hunt Company information, a temporary difference exists at year end because Hunt accounts for a litigation loss differently for book and tax purposes. The book basis of the liability is $50,000, while the tax basis is 0. What is Hunt's deferred tax asset at the end of 2025? The total tax asset at the end of 2025 is $10,000. And we compute that by taking the book basis of the litigation liability here and the tax basis of the litigation liability here, and that results in a cumulative temporary difference at the end of 2025 of $50,000. Our tax rate's 20% again, so our deferred tax asset at the end of 2025 is $10,000. So in this case, Hunt records a deferred tax asset of $10,000 at the end of 2025 because it represents taxes that will be saved in future periods as a result of a deductible temporary difference existing at the end of 2025. So Hunt can also compute the deferred tax asset by preparing a schedule that indicates the future deductible amounts due to a deductible temporary differences. So here's our future years. Here's the future deductible amounts, the tax rate of 20%, and the deferred tax asset at the end of 2025 of $10,000. Now we'll refer back to Hunt information again. And because this is the first year of the operations for Hunt, there's no deferred tax asset at the beginning of the year. The income taxes payable is $100,000. That's $500,000 times 20%. So what's Hunt's income tax expense for 2025? Well, here we're going to take the $100,000 tax expense for 2025. That's our income taxes payable. And to that, we'll start with our ending 2025 deferred tax asset and our beginning deferred tax asset for 2025. And that results in a deferred tax benefit for 2025 of $10,000, resulting in income tax expense in total for 2025 of $90,000. And that's very similar to the Chelsea example. The determination of income tax expense starts with income taxes payable, that's the $100,000, and then subtracts the increase in deferred tax asset, $10,000 during the year. Okay, deferred tax benefit. In the Hunt example, that results from an increase in the deferred tax asset from the beginning to the end of the accounting period. So, 1, the deferred tax benefit is a negative component of income tax expense. And 2, the total income tax expense of $90,000 on the income statement for 2025 thus consists of 2 elements, the current tax expense of $100,000 and a deferred tax benefit of $10,000. Now, if we look at the recording income tax expense, deferred income taxes, and income taxes payable at the end of 2025, Hunt is going to make the following entry. It will have income tax expense of $90,000, deferred tax asset of $10,000. So the income taxes payable will be $100,000. So we continue with the Hunt example. At the end of 2026, then, the difference between the book basis and the tax basis is 0. Income taxes payable is $90,000, which is $450,000 times 20%. So, what is Hunt's income tax expense for 2026, and what is the journal entry to record the income tax expense, income taxes payable, and the change in the deferred tax asset in 2026? So as we look at that, the Hunt's income tax expense will be calculated by taking the $90,000 current tax expense, the income taxes payable, plus the deferred tax expense benefit for 2026, resulting in income tax expense total for 2026. And as indicated, the determination of the income tax expense starts with income taxes payable, $90,000, and adds the decrease in the deferred tax asset during the year. That looks like a good place for us to stop this video. And when we return, we'll take a look at finishing the second part of this solution. Until that time, bye for now.